Well, hello again. It's Lee Thurburn, and you are on another episode of Live Stream Lee, where we talk about business. We talk about how to make your business grow faster. We talk about how to get more time so you can spend it with your family. And most importantly, we talk about ways to make your business more profitable in the long term. So when that day comes that you want to stop and smell the roses, that you can sell your business and get a significant amount of money. That's the whole goal of Livestream Lee. And it starts with getting your business to grow faster. And there's a lot of things that factor into getting your business to grow faster. First and foremost is get more customers. But you know what? You can't get more customers until you have money. And you need money to start your business. You need money to market your business. You need money to grow your business. So today's episode is finishing up I thought it was going to be a 4-part series, but there's just too much to cover in 4 30-minute sessions. So we needed one more. So today is part 5 of a 4-part series. So basically you get a bonus day where we tidy up and finalize the conversation about getting capital for your business. Before we get into that, I want to remind you to go to livestreamlee.com. And there you can join the community. And when you join the community, you get all kinds of wonderful things. First of all, you get an account with Apricot Rocket, which may very well be the most potent and powerful digital marketing tool that is available on the internet. It is good stuff. Of course, I'm a little biased. I designed it, had some people build it for me, my developers, but it is, in fact, a really good program. It's a combination of a CRM, a shopping cart, email marketing, lead generation, marketing automation, just all kinds of wonderful things. And it's totally free. You can create an account and you never have to pay anything, up until you start to grow. And then when you get a certain size database, there are some nominal costs. But generally speaking, get started with it, play with it, it's free. Now, when you create that account, you're going to get access to content that is only available on livestreamlee.com as a member. That includes documents that we've talked about, slide decks for this show, copies of private placement memorandums, subscription agreements, all kinds of stuff that can help you in different aspects of your business. So you definitely want to do that. But there's another big reason, and that is if you join livestreamlee.com's community, get yourself an account. We're going to ask you to tell us about your business. We're going to help you build a website. Well, let me rephrase that. We're going to build a company profile. We're going to learn about your business. We're going to learn about what you sell, and we're going to try to help connect you to customers. Part of that process is we take that information and put it on a website that you can use for your business if you don't already have one. If you already have one, that's great. Just use this like you would LinkedIn as a way to market your business. We're going to help you make connections to potential customers who are looking for you. So there's all kinds of reasons why you want to do that. Before I get started, I want to talk about something that's near and dear to my heart, and that is what you don't know. It is inevitably what you don't know that comes to bite you in the rear. And one of the most important ways, or the best ways that you can protect yourself against what you don't know, is to build a team around yourself of people that know more than you do. And here's a guy that knows more than I do. At least, certainly, he knows more about risk management than I do. Carlos Cantu is an awesome, experienced entrepreneur and risk management specialist. He helps companies avoid liability for things they didn't even know they might be liable for. One of the reasons why you want to talk to Carlos is because he'll be glad to have a conversation with you and ask you some questions about risks that you may or may not already be aware of, and let you know whether or not he can protect you from those risks. So again, what you don't know is the stuff that you need to worry about. What you do know, you're going to be able to be prepared for. Carlos is in the business of protecting you from the stuff that you don't even know that you need to be protected from. Now, on Wednesday of this week, we're going to talk to Susan Stageman. Susan is going to be our interview on Wednesday. It's a special bonus interview day. Susan literally wrote the book about neuro-linguistic programming and how to train people to be more proficient and better at it. She is a master certified NLP trainer, and you are going to want to tune in on Wednesday at 3 o'clock. That's April 21st. And then on Friday of this week, we're going to talk to somebody that you've heard me mention before, Dan Nelson. He is a genealogist, and Dan has retired, and then he went out and just started doing what he loves doing, which is genealogy research, and he's created a whole new, I don't know if he wants to call it a career, we'll find out, but it is definitely a good little business that he has set up, taking a hobby and turning it into a business. So he gets paid to do what he loves to do. Now, how does it get any better than that? So we're going to talk to Dan and learn how he did that. And while we're on the subject of Dan, I want to encourage you to come back on Friday and listen to Dan's story. Dan's just a fun guy. He's got great stories. So you're going to enjoy that. All right. Let's go ahead and jump in and start talking about what we were going to finish up on today, which is how to raise money. So I'm going to turn off this little thing, get a little more space, a little more visibility here. And crowdfunding. We're going to pick up on the subject of crowdfunding. So what have we talked about so far? Well, we've talked about raising money from friends and family, raising money yourself, friends and family, partners. We've talked about venture capital. We've talked about angel investors, and we've talked about private placements. So we've covered a lot of ground. We did also talk about crowdfunding, but I didn't get a chance to finish on that. So I want to kind of start there, finish that up, and then move into debt financing. Crowdfunding is a relatively recent development in the world of financing. Back in 2012, Obama passed the Jobs Act, which enabled or allowed Congress to implement, and the SEC to enable regulations related to raising money on the internet. Now, crowdfunding basically boils down to a real simple premise. You get lots and lots of small investors to kick in small amounts of money to help fund your business. And conceptually, it's a very cool thing. The reality is there's a few sort of tricks that you have to navigate, a few little twists and turns on the road to raising money. You can't just put up a website and invite people to come and give you money. There are some things that you have to do. But generally speaking, crowdfunding is about getting lots and lots of small investors, regular people, not big-time Wall Street or big-time Silicon Valley people, to kick in little bits of money to help you fund your business. Websites are available that will, for as little as about $100, allow you to collect money from potential investors. There are 4 types of crowdfunding websites: cause-based, like a GoFundMe, which are perfect if your grandma needs a hip or if you need to support a mission. That's great, cause-based crowdfunding. Rewards-based, these are where you basically have a business and you need some money to be able to produce a product that you haven't produced yet. Hopefully you have a prototype, and then you can turn around and show people what that would look like. They can pre-purchase it so that when you have enough pre-purchases, you can take all that money and go out and build the actual production line and satisfy the pre-orders. That's basically what a rewards-based is. Debt-based funding, places like lendingclub.com and others, are basically micro-lending sites where people can lend you small amounts of money. Collectively, it's a big amount. But they individually can lend you $500 or $100 or $1,000, small amounts, and you might need $20,000, $30,000, $50,000. So you get a number of people to lend you small amounts of money, and collectively it provides you enough. So that's what debt-based crowdfunding sites are all about. Then you have equity-based crowdfunding sites. Now, the whole purpose behind equity-based crowdfunding sites is for you to offer a piece of your company out to the public and sell shares, small slices of your company, to the general public. It is a lot like doing an IPO. And as a result, there's a number of things related to doing an IPO that you have to think about. First of all, there are several different sort of layers, if you will, of crowdfunding equity-based websites. 2 of them we're going to talk about, called Regulation CF and Regulation A+. are important because they're really very popular right now. Now, Regulation CF stands for Regulation Crowdfunding, and it is specifically designed if you don't need more than $1,070,000. It's a great way for you to raise that money. There is no audit required for you to raise money through a regulation crowdfunding capital raise. We're actually going to talk a little bit more about this in just 1 minute. Regulation A plus is like a miniature IPO. Regulation A is the SEC regulation under which IPOs are offered through the NASDAQ or the New York Stock Exchange or for any other regulated exchange in the United States. Regulation A is an expensive proposition because you have to meet a lot of highly complex legal and financial requirements. And I'm going to tell you, it's going to cost you $500,000 to $1 million to raise money at a minimum, to raise money using an IPO. Regulation A plus lets you raise based upon whether you hit a tier 1 or a tier 2 sort of qualification. Raise either up to 20 million or 75 million. And your total cost to do a Regulation A plus tier 1 can be well under $100,000, can be in the $50,000 to $100,000 range. That is inexpensive. Now, tier 2 is a little bit more complicated, but it lets you raise even more money. When I took my company, FlashNet, public back in 1999, we did it through the NASDAQ. We raised $54 million. Regulation A plus was not available at that time, so we raised $54 million, and it cost us somewhere in the neighborhood of $750,000, $800,000 to do that. That was expensive, and so Regulation A plus basically would have allowed, if it had been in place at that point in time, we could have used Regulation A plus, and our cost would have been under 200,000, probably closer to 100, 125. And that's because the burden of legal and financial requirements that we had to meet would have been significantly less. Now, Regulation A plus will not let you offer your stock on the New York or the NASDAQ exchanges. That's not the way it works. It's not a full-fledged IPO, but you can sell stock to the public. And you have very few restrictions in terms of how you go about it. And in fact, there are aspects of Regulation A plus that are really, really attractive because they allow you to do marketing to get the public. I mean, radio marketing, newspaper marketing, to make the public aware that you're offering stock. And you can't even do that in a Regulation A IPO. Now, I want to focus a little bit more attention on the Regulation CF. So we're going to talk a little bit more about that. Regulation CF allows you to raise a maximum of $1,070,000. You can sell stock to an unlimited number of non-accredited investors, and that's a big deal. These are people that can spend, generally speaking, $1,000 to $2,000 on your offering without any real restrictions on them, presuming they meet a few simple requirements. So you have the ability to also to advertise on the radio. You can even test the waters. You can pre-sell and get subscription agreements or indications of interest from people without having to actually go through the registration process. So you can test the waters, so to speak. You can raise up to $250,000 with nothing more than management's representation of the financial statements, which means that if you're running a set of QuickBooks, you can print off financial statements, and as long as you, the management team, think that they're accurate according to generally accepted accounting principles based upon your personal understanding, you can raise up to $250,000. Now, that dollar amount is actually a temporary number because of COVID. The normal number is $107,000, but that's been temporarily increased to $250,000 under the management representation exemption. Your securities can be traded by the shareholders after the stock has been offered and sold. Now, you must use a financial intermediary to do a regulation crowdfunding offering and be able to do all of these things. So it's kind of like listing on the NASDAQ or the New York Exchange. The registered financial intermediary actually handles the sale, handles the presentation of the information. They structure what your document build looks like, and they actually can also offer an aftermarket for your stock to be traded on. Now, it is not an open market. It is not a public stock exchange, but they do have the ability to provide aftermarket liquidity for after people purchase your stock. So it's a big deal. It's a relatively simple way to get into publicly traded. Now, I want to give you some websites, which are great websites for you to go to learn more about regulation crowdfunding. You can go to startengine.com, wefunder.com, republic.com, microventures.com, and seedinvest.com. These are websites that offer, as financial intermediaries, the opportunity for you to offer stock to either the public at large or even through private placement memorandums to accredited investors. These are great websites. They did not exist at all prior to about 3 years ago. Most of them are relatively new because this is the newest, most cutting edge aspect of funding and financing businesses that's available in the United States. And it's all as a result of the Jobs Act back in 2012. It took a long time for it to get fully implemented and all the details to be figured out. Now, we're going to move on to cover debt financing. As it turns out, debt is the singular most popular tool for financing businesses. And part of that is because the whole U.S. economy is built around banking and debt. I don't know if you know this, but banks are among the most profitable businesses out there. And it's really primarily because they borrow money from other people in the form of depositors, and they lend it to other people in the form of loans, and they charge a huge spread on the difference. And so, I mean, in the days right now where they're paying, say, 1%, maybe even less to borrow money from you, the depositor, if you put in a savings account or a CD, you get paid about 1%. They'll loan your money out at anywhere between 5 and 8%, maybe even more in some cases. So they're basically getting a 5 to 8 times markup on the cost of the product that they're selling. They're getting money from you that they pay 1% on, and they're lending that same money back out and earning 5, 6, 7, 8%. So they're making huge margins, which is why they're so profitable. But because banks love lending money, our whole economy is built around literally easy credit, which is dangerous because credit means if you're borrowing money, you got to pay it back. Unlike equity funding, which is very patient and is glad to get a 3, 5, 10, 20 times return and wait 3 to 5 years and take a risk to get that. Banks don't want risk. They want to know that their money's coming back, so they start making you make payments immediately. All lenders do the same thing. So about half of all business loans are denied. They are not approved. And there are 4 main reasons why business loans are not approved. First, it's weak personal credit history scores. Scores of at least 650 really are needed to be able to get most credit funding, most bank funding for most kinds of commercial loans. Now, when you go for a commercial loan, you're going to have to, if you own a small business, you're going to have to sign on it. So you're going to need personally good credit. Another reason why loans are refused is because of inexperienced management that has less than 2 years experience with the business and or less than 2 years experience in the industry. Insufficient collateral. Remember, a bank will never lend you money if you need it. They'll only lend you money if you can prove that you don't need it. That's the way banks work. They don't want to take risks. They're not in the risk business. They're in the risk avoidance business. They want to make 5 to 8 times the money back on the cost of the money that they lend you, but they don't want to take any risks. That's the business model they have. So they want to know that you've got significant personal credit, personal collateral, and assets behind the loan. So one of the things they look at are financial indicators, ratios, cash flow ratios, debt coverage ratios, liquidity ratios, leverage ratios, those kinds of things. So they're going to run you against a set of standard ratios for your industry and against your competitors. They're going to look at the credit worthiness, the loans, the collateral, the signature, the guarantee authority and reliability, all those kinds of things before they lend you money. Regarding collateral, generally speaking, banks and most financial institutions will use approximately the same metrics. They will lend you about 75% of the value of your accounts receivable. So if you have $100,000 in accounts receivable, they'll advance you $75,000, and then they'll take over the collection process and make you work with their standard collection process modality. If you have inventory, they'll typically lend about 50% of your inventory. If you have equipment, about 75% on equipment. And then on commercial real estate, anywhere between about 75 and 90%, depending upon a variety of variables, primarily what the market looks like and what the demand for your particular unique piece of property is. So these are general parameters about what they'll lend. From a personal financial information perspective, banks are going to want personal financial statements over anybody that's an equity participant with 19% equity in the business or more. Probably anybody with that much or more is going to be required to be a guarantor. If you don't have enough guarantors, they may require that you get guarantees from other people, even if they don't own enough. It's not uncommon for some of your board members to have to step up to be able to help because, you know, as a founder of a company that's trying to borrow money, if you're working full time for the company and the company fails, your ability to repay is gone. So banks don't necessarily put a whole lot of reliance and trust in your personal integrity and ability to repay, because quite honestly, if you don't have the ability to repay, just because you own the business and work for it full time doesn't mean that you're going to have the ability to repay. So they're going to want to see other people that have other sources of income. You're going to need to have personal tax returns for at least 3 years, credit reports, current resumes, and all of those kinds of things to be able to get a bank loan for a commercial business. Now, from the business perspective, you're going to need 3 years worth of tax returns and 3 years worth of year-end financial statements. They may even require that you have audited financials if the loans are large enough. Now, typically, if they're going to ask you to have audited financial statements, you're going to be large enough to where they're not going to require personal guarantees. Now, that's not a 100% sort of guaranteed thing, but if your business is large enough to need and have audited financials, you may very well be large enough and well established enough to not have to provide personal guarantees, but don't be surprised if they do ask. They're going to want current financial statements of the business that are relatively recent, 30 to 90 days. They're going to need an aging of your accounts receivable and your accounts payable. They're going to want a debt schedule as well as all of your current business papers, copies of your lease agreements, copies of your bylaws. They want to make sure all your corporate documents are up to snuff and current. So they're going to need all of those kinds of documents to justify or be able to make a loan. And there's 2 reasons for that. One is because they just want to make sure that you're a good business manager. But second, banks get audited, and these are the things that auditors look for when they look for the loan supporting documentation to support the bank's loan portfolio. They'll pull a bunch of the loan packages out and go through and tick off and make sure that all of these things were collected before the loan was made. So banks need to cover themselves, and that's why part of why they're going to do this. Now, from a small business financing strategy, bank loans account for almost 50% of, in other words, almost 50% of all businesses have bank loans as part of their financing strategy. About 43% of all businesses use and rely on retained earnings, in other words, cash flow, as part of their financing strategy. And about 37% of small businesses rely on credit cards that have been issued as also part of their financing strategy. Now, other less significant sources of capital are vendor financing, private loans from family and friends, leasing, especially of vehicles and small equipment, SBA loans, asset-based loans, and private placements of debt. So these are the typical sources of funding and financing that small businesses rely on. Now, from a debt capital perspective, commercial banks are your biggest players. They handle the lion's share of debt. The average small business loan is a little over $180,000, and about 12% of entrepreneurs receive bank loans as part of their funding to start their business. Banks offer essentially two types of loans, short-term and long-term. Short-term loans will typically have home equity as collateral. There'll be loans for lines of credit and floor planning. If you're in a vehicle sales business, you'll get a floor plan loan. You might also get installment loans or term loans. If your bank says we don't make a loan, why they reject, there's basically 6 kinds of reasons. Our bank doesn't make small business loans. If you hear that, you've chosen the wrong kind of bank. Go shop for a different kind of bank. If they say they don't know enough about your business, that's your fault because you haven't provided enough information about your business and you don't know your banker. Try not to make the first time you meet your banker the day you go in and ask for $300,000. It's best if you can be on some local boards of charities and things like that so that you know the bankers. A lot of bankers are on charitable organization boards. So if you volunteer on some boards that support causes that you support, then you'll get to know, without a doubt, you'll get to know some bankers. And those make great banks to do business with because they know your commitment to the community. Banks love community commitment. If they say you haven't told me why you need the money, shame on you. You haven't done a good job of presenting a business plan to them. If you say your numbers don't support our loan request, that's basically telling you that either your cash flow or your ratios are not going to support the repayment of the loan, and they don't believe in your business plan. So you need to redo your business plan. If they say you don't have enough collateral, well, that's pretty self-evident. That means that you're going to need some guarantees because you don't have enough collateral. Bankers, remember, they never lend money to anybody that needs it. They only lend money when you can prove you don't need it. Your business doesn't support the loan on its own. Well, they're going to require that you have some guarantors. There are asset-based lenders out there for almost every kind of asset that exists. I came across one time a lender that specialized in tractor trailers, the trailers for tractor trailers, over-the-road long-haul trailers. That's all they lended on was over-the-road long-haul trailers. They knew that industry inside and out. That's what they lended on. So whatever industry you're in, there's probably a lender out there that specializes in that. You can find them on the internet. Again, they typically stick to the same kinds of general standards as any other lender. Asset-based borrowers stick to the 75% of accounts receivable, 50% of inventory, 75% of equipment, and real estate, same kinds of numbers that a bank will. There are other sources of debt available out there. There's vendor financing, there's equipment suppliers, there are commercial finance companies as opposed to commercial banks. You can even go to savings and loans. You can go to insurance companies if your loan request and your business is large enough and well enough established. You can get money from private placements, from small business investment companies and small business lending companies. You can also get money from the federal government and or federal government sponsored institutions. Today in the world of COVID, we have PPA loans direct from the Treasury and the Small Business Administration. They are made through commercial banks. And then, of course, you have SBA loans, especially EIDL loans, economic injury disaster loans. This is readily available money that's current. That's in the period of April, May of 2021. There is a lot of money still available under the various stimulus programs out there. Almost certainly your business can support and or apply for either a PPP loan or an EIDL loan or both. I highly encourage you to get in touch with either a lending specialist or your CPA, because these kinds of funds are currently readily available. They're not hard to get, and they have extremely generous repayment terms. In some cases, they have repayment terms so generous you don't have to repay. How much more generous can it get than that? So if you haven't yet pursued a PPP loan or an EIDL loan, get on Google and go look for them and talk to your accountant, because that money is readily available. All right, we are out of time, so I'm going to pop back over and close with a pitch for Dan Nelson. Every couple of weeks, Dan sends out a newsletter. I got one on Saturday, and it had a fascinating story about why the gunshot at Lincoln's assassination wasn't heard. You'd think, golly, you're in a theater and somebody shoots a president in the back of the head. Everybody had to hear that, right? Nobody heard it. Why? Because they were all laughing. What were they laughing at? A joke. What is the joke? Well, if you want to know what the joke is, go sign up for Dan Nelson's newsletter. I love historical stuff, and he has some of the most fascinating stuff that he kind of uncovers as part of his natural research into people's genealogical history. Dan's a great storyteller. He's got a really interesting business. Sign up for his newsletter. Go to livestreamlee.com, click on the Dan Nelson link, and also tune in on Friday of this week, April 6th. I forgot the date. Here's the date, April 23rd. Tune in on Friday this week, April 23rd, to hear my interview of Dan Nelson. He's an interesting guy. Again, go to livestreamlee.com, join our community, and I'll see you tomorrow as we talk about how big is your dream? What do you have a big dream? How big should your business be? That's what we're going to talk about tomorrow. See you at 3 o'clock tomorrow. Cheers.